Hello, Arkansas, and welcome to this week's edition of Arkansas Money Talk, brought to you by the team of Retire Path Wealth. I'm your host, Kristen Oakley, and joining me in the studio is the president, Dale Colclaser, and co-founder, Mark Smalling. We've got a great show for you today. You know, the reality is that success in retirement isn't about how much you've saved, it's about how much you get to keep. And for so many of you, you've done a great job of saving, but the majority of your wealth is in something like a traditional 401k or a traditional IRA, those tax-deferred accounts, which means you are looking at potentially a very high tax bill over the rest of your life. So today's show is all about answering the question, could a Roth conversion be right for you? Now, there's lots of misinformation out there, so today's show is going to give you what you need to understand, including 8 factors you should consider before you engage in Roth conversions. And this is where you guys come in. This is your guidance, your expertise, what you do for folks day in and day out. Dale, Mark, so good to be here with you.
It's great to be with you this week.
Great day.
Yes, well, and this is a conversation you are having a lot with folks.
We
right?
have it every day.
Every day.
Every day.
All right,
Yeah.
well, let's dive in. Today's inspiration for the show was birthed out of an article that came out in Kiplinger not that long ago, which addressed 8 factors you should consider before doing a Roth conversion. And the first 3 factors we're going to look at today really live in the tax foundation of your financial plan. So first up, factor number 1, current tax rates versus future tax rates. So how do today's current tax rates versus what could happen in the future help determine whether it would make sense for someone to potentially convert either all or some of a traditional IRA to a Roth?
Yeah, it's just a huge consideration because so many times people have no concept to how their tax calculations are actually made. And the reality is the code that we're in today, the vast majority of you out there, we're in the lowest marginal tax bracket. So again, I'm going to talk about the value of the brackets, which are 10, 12, 22, and 24 in most cases of what we're dealing with. But when we break those through due to the fact of larger standard deductions and other factors, we're in the lowest marginal rate. So the income tax we're paying today, even though I know it's not less painful, is the lowest we've seen in a long time. And for most of us in our entire working career. When we hold educational events, we always ask this question, do you think taxes are going up or down? Well, the reality is we're about 100% going on 6 or 7 years here, the taxes are going to be higher in the future. So the reality is if I think taxes are going to be higher in the future than they are today, and tax rates are very, very low, if I'm just thinking of a concept of a sales shopper, maybe I want to pay my taxes today. We know, again, one of the largest expenses I'm ever going to pay in retirement. Part of all that qualified money is all already Uncle Sam's because it's deferred income, folks. It's not assets completely. So as I draw the money out of those accounts, they become taxable. Just because they're taxable doesn't mean the tax rate I'm going to have to pay. So having a plan in place for how we address those things can make a lot of sense and help us to get an understanding. Does Roth conversion or contributions to Roth plans make more sense today, not just the timing factor for when I'm going to use the money, but for how I'm going to pay taxes on those situations.
Right. I don't know anyone who doesn't love a good sale, right?
Yes, ma'am.
It's really eye-opening when we can show folks, okay, taxes are on sale today.
Correct.
Next up, factor number 2, is your adjusted gross income. And this is where people are often surprised. So what does someone's adjusted gross income, how does that play such a critical role in deciding how much to convert and when?
Well, it absolutely does, Kristen, because when you do a Roth conversion, you're going to increase your adjusted gross income. You're going to pay more taxes today than you would if you didn't do a Roth conversion. And not only are we paying more taxes today, it can affect some other things too. Some of our deductions that are allowed, we can incur some surtaxes. There's actually, if you're 65 or older and you've been using standard deductions, there's extra senior standard deductions that are associated with the big beautiful bill that we could actually lose if we get above a certain threshold. And so it's going to, and then also if we're on Medicare, we could call some IRMA, income-related monthly adjustment amounts, end up paying more on our Medicare premiums than what we would otherwise. So there's a lot of factors to take into consideration when we're doing that, and those are things that we calculate when we're looking at each and everyone's situation.
Yes. And I think when folks try to do all this on their own, one of the biggest pitfalls is they look at Roth conversions in isolation from the rest of their financial picture. And that factor alone points to the fact that you can't afford to do that. You have to look at how all these different pieces are going to interact with each other.
Having a professional help you do it is paramount.
It's very key.
Trying to do it on your own, you're liable to make a lot of mistakes.
Yes.
Well, and in some of those times too is we talk about professional. We're not talking about the CPA compliance side here either, because the reality is in most of those cases, they're trying to reduce your taxes today, not so much planning to looking forward, and may not always take into consideration some of the issues that Mark just told you to be aware of, where with IRMA, with conflicting to lose the deduction. I'm sure most CPAs are going to pick that one up for the big, beautiful bill scenario, but maybe not for some other factors that come along, and then with the anticipation of future.
Yep, for sure. Well, factor number 3, this is a perfect segue, involves secondary taxes. For example, how can a Roth conversion unintentionally increase someone's taxes on their Social Security benefits or investment income?
Yeah, well, especially if you're in the lower income tax brackets, some of your Social Security may be taxed in a zero bracket. Almost always the best one when we're talking about total income. But the reality is the more other income that I have after I've done that provisional calculation may make my Social Security now go from 0 to 50 to 85% taxable. Now, again, let's not look at that in isolation, just as Kristen mentioned, because the reality is still my Social Security is only going to be 85% taxable at the most. I've got to look at my overall tax situation as I add this additional income in because, again, as Mark's already alluded to, if I'm 65 or older, I'm maybe picking up another $6,000 to $12,000 worth of standard deduction, which may still cover those taxes where I don't actually have a tax bill due. That's the real focus here is the outcome of the end of that calculation, not so much the beginning. So don't just think about, oh gosh, I'm going to make my Social Security taxable, because here's the reality. If I defer that out into the future and I get to RMD age and I'm forced to begin to take monies out later at higher income tax brackets, I may never be able to avoid making my Social Security 85% taxable at that point, and that being actually a greater negative consequence to me.
So much to think about. And if somebody's watching right now, and so far we've only made it through the first 3 factors, right? We're going to do our best to get through 8 today. But if you're watching right now and you're going, gosh, I didn't realize that so much went into this. And now you might be asking yourself, I don't know, could it be right for me or not? We have a very special free resource that we want to share with you that you can actually access throughout today's show. We call it our Roth Readiness Quiz, and you can access it by going to retirepathrothquiz.com or by scanning that QR code. Mark, what is someone going to learn when they take this quick online interactive assessment?
Right, Kristen, once they plug in their information into the quiz, they're going to get a high-level snapshot of what income, taxes, timing looks like for them. So it's going to help provide them with information, some clarification of what that would look like in their situation, and also kind of clarifies that they may need some help as far as professional guidance as far as putting together a Roth conversion strategy.
Yes, and this is where you guys come in. And I think a lot of folks watching right now might realize, okay, this is so much more than just a tax move. This is really a planning decision, and it's so important for you to have clarity and confidence as you move forward. And you're looking at, okay, not just should you convert or not, but how much and when over how long of a span of time. So Dale, if somebody's wanting more help and really figuring out what this looks like for their situation, what would you say to them?
Well, the beauty is if you'll go to that quiz, it's going to give you in the first section the reality of how much opportunity. It's going to tell you, is it moderate, is it an exceptional opportunity for you? Then walk you through what the actual effect of that outcome is. So if it's always something that you said, gosh, I don't need to do Roth because I'm too old, I make too much money, or whatever the issue that you've been told that Roth doesn't make sense for you, but you've never actually done research and investigation, that's exactly what this tool is designed to do. If you're not working, we've got these piles of money sitting over here and we're trying to determine which one do we access first or in what order, what time, what year. it's going to help give guidance and clarity to that situation.
For sure. And that's not the only resource we have for our viewers. Of course, you're also offering your complimentary written income plan.
Yes,
Talk
ma'am.
about how these two things go hand in hand.
Well, once we know or have an anticipation that RMDs possibly are going to be an issue, the aspect of can I get an improvement to my outcome? Because again, if you've watched the show before, which I know y'all have, the reality is we talk a lot about taxes are the one thing we have more control over than market outcomes. And so if I put a plan in place that helps me utilize the tax brackets that I know and understand when I look at things in an overall situation, we know there's an opportunity we can bring value to your outcome, to actually put more money in your pocket, because it's that net number that shows up that you get to spend, that you get to pass to the next generation, that's really optimal when we assess assets.
Yeah, for sure. Well, clearly so much goes into this. We've only covered the first 3 factors. Yes. We're going to try to get through 5 more, but Dale, Mark, thank you so much. If this is resonating with you, if you have questions about your own situation, or if you're already working with another financial professional and they're not having these kinds of conversations with you, you owe it to yourself to get a second opinion. And the team of Retire Path Wealth would love to be able to provide that for you in the form of your very own complimentary written income plan. So we encourage you to reach out and schedule yours today. 866-724-3893 is the number to call. Or if you'd rather connect online, simply scan that QR code and that will get you connected as well. Stay with us. When we come back, we're going to dive into the next set of factors you should consider before engaging in Roth conversions. These are going to really speak to the importance of coordinating the strategy as part of your bigger financial plan. So stay with us. We'll be back right after this.
We're based in Little Rock, Arkansas. We're licensed literally in 37 states, though, so we can reach across the realm. The greatest benefit of being independent is simply choice, but always having basically the entire investment universe to go search for the best answers for individual clients and then helping to narrow that down. We do a very solid job up front in our data gathering process of not just getting information, but getting a sense of feeling what a client's real objectives and long-term goals are based on where their finances are. From years and years of doing what we believe is simply doing the right thing, we're going to find and get that answer for you, not, hey, here's someone else you can call, see if they can answer this question for you. We like to have those resources on hand.
I'm Dale Calclaser, Certified Financial Planner with Retire Path Wealth. You've worked very hard and saved for retirement, but how much of that money will you actually keep? If your savings are in a traditional IRA or 401k plan, Uncle Sam has a claim on every withdrawal you take. And with tax rates expected to rise, the cost of waiting could be significant. A Roth conversion may help you lower your future tax burden. Want to know what your liability could look like? Simply scan the QR code or visit retirepathrothquiz.com to take our Roth conversion quiz today and see if conversion makes sense for you.
Well, welcome back, Arkansas. You're watching Arkansas Money Talk. I'm Kristen Oakley here with both Dale and Mark from Retire Path Wealth, and we're so glad you're joining us today. If you're just tuning in, we are working our way through 8 factors you should consider before engaging in Roth conversions. And if you are just tuning in and joining us, we want to make sure that you're aware of this awesome free resource we have for you. We call it our Roth Readiness Quiz, and we invite you to visit retirepathrothquiz.com. You can also get there by scanning that QR code. It'll just take you a few minutes, ask you some questions, and help you get a little more clarity on could this strategy be right for you to help you potentially lower your tax bill throughout the rest of your life. So we covered 3 factors already that should be considered, which really lay the tax foundation of someone's situation. This next group we want to talk about of factors really move from cost to strategy. And what's interesting is I think a lot of folks, when they hear Roth conversions, they have a tendency to maybe oversimplify the decision and underestimate just how much coordination is important and how much timing is required to get it done right. So let's go with factor number 4, which really focuses on the advantages of Roth accounts. So Dale, what is making Roth accounts so appealing when they're used correctly as part of someone's comprehensive financial plan?
No tax liability upon withdrawal. I mean, it's the beauty of the situation of I have money that goes into an account. The account gets larger, we hope, right? That's the objective. There's the first one. If yours isn't getting bigger, give us a call anyway. But the reality is that account should grow. When I take distributions from the account, I don't owe tax on the earnings as long as I've met my qualifications. Again, let's talk about those real quick. 59 and a half, and the account's been open for 5 calendar years. The next major opportunity is the fact that there's no required minimum distributions on that account. So if I'm accumulating money, especially money that I know I don't necessarily need for my own income purposes, again, the reason I know I need that is because I've completed the written income plan process. I know there's money that doesn't need to fit into my situation to guarantee income for me. This is money I can now leave for legacy purposes. And so I don't have to take withdrawals from that account to make it smaller as time goes on. Not only do I get to keep it as income tax-free, once it passes to my spouse, she gets to keep it as well. When it then passes on to the next generation, the kids get to keep it for another 10 calendar years after that before they have to take the money out. One of the most unutilized factors is when I do a Roth conversion and I move money over, a lot of folks' thought is gosh, maybe I want to spend that in the next couple of years. The reality is I still have the ability to spend the money that is in my principal because that's basis. Basis is always income tax free, folks. So just because I've put it in the Roth doesn't mean I can't spend my principal out in the first 5 years, because I can. But now what I've done is I've kept all of the earnings tax deferred until I meet that 5 calendar year aspect. Maybe I'm never going to spend the earnings, but now I have kind of a income tax free savings account of a sort in position to use for other spending.
Awesome. Yeah, and moving money from taxed always to taxed never again, that's the beautiful thing about doing a Roth conversion,
as long as
right?
I'm doing it strategically.
Yes, strategically and correctly, which brings us to factor number 5, which is the timing. This one alone is where so many mistakes can happen for folks when they try to do it on their own. So, Mark, explain why a multi-year Roth conversion strategy is often more effective than just doing it all at once.
Right. Well, I mean, it's easier to stomach, for one thing, because most people don't want to pay taxes. Sometimes we run the calculations, the computer says, the program says, do it all at once. But paying the taxes all at once is harder to do and harder to stomach. So oftentimes spreading it out throughout certain years, keeping below certain tax bracket thresholds, and then we mentioned earlier IRMA thresholds on losing the extra senior standard deduction. Those all come into play, and we calculate those when we're trying to determine how much we should do in Roth conversion strategies in any given year. And it's not a one and done. It's not just set it and forget it. This is something we come back to every year as we're doing our annual income planning to determine how much room there is. And sometimes we leave room towards the end of the year because life happens every day. We don't know what events are going to occur where we may need dollars to actually spend because either an opportunity or something else occurred during the year that we need to spend the dollars that we might have otherwise converted. So we need to keep some flexibility in that strategy too.
Absolutely. And then factor number 6 brings healthcare into the picture. This is another one that a lot of folks miss. So how can doing a Roth conversion potentially impact someone's Medicare premiums and trigger those IRMA surcharges that a lot of folks aren't even aware of?
IRMA is one thing, but I'm willing to back up it if I'm not 65 yet. The idea of having additional income out and I'm in an ACA plan, because ACA plan premiums are all simply based on my income. The higher my income, the higher my ACA premium, and with a whole lot of uncertainty of tax credits that are out there, that's a huge consideration if I'm retiring before I'm 65. Okay, so keep that in the mind. But the big one is IRMA, obviously, because once I'm now on a Medicare plan, they're going to look back 2 years to my income threshold, and wherever that income is going to determine if I'm going to pay surcharges. Sometimes those surcharges can be 4 to 5 times what the original premium was. Here's the thing to remember, folks. If you're married and we're married filing jointly, if I've done it to myself, I've done it to my spouse. So it's a double whammy when it comes to those higher health premiums, simply because I'm generating income. Again, whatever sits in that IRA is deferred income, not assets.
Yeah, no, you make a really good point. And again, this is why folks can't afford to just look at the Roth conversion conversation in isolation from all the other pieces of your financial life. So if you're curious and you're wondering, okay, could this be right for me? Again, we have the Roth Readiness Quiz. You can access that by going to retirepathrothquiz.com or by scanning that QR code. But that's just the first step. The main way the team of Retire Path Wealth is going to be able to help and serve you is by you coming in and sitting down and taking advantage of their complimentary written income plan. And as part of that discussion, they'll be able to look at your situation and help you potentially determine, does it make sense for you to do a Roth conversion? If so, how much and when? So we encourage you to reach out to the team of Retire Path Wealth and schedule yours today, 866-724-3893. Or again, you're welcome to scan that QR code and that will get you connected as well. Stay with us. We'll cover the remaining 2 factors that go into deciding should you convert into a Roth right after this.
I'm Dale Call-Clazier, certified financial planner with Retire Path Wealth. The stock market isn't the only risk you take in retirement. One of the biggest and most overlooked is the tax bill that's tied with your 401k and IRA accounts. As tax laws change, so can the value of your income. A Roth conversion could help you reduce that risk and give you more control. But timing and strategy matter. Want to see if the conversion fits your plan? Take the Roth Conversion Quiz today. It's free, it's quick, and it may help you make much smarter decisions. Scan the QR code or go to retirepathrothquiz.com and take that quiz today. As Americans, we strive for better, from a better house to a better career to a better life for our kids. Better has become the American way. But when it comes to your retirement, what does better mean to you? Does it mean more income, a flexible lifestyle, better options and solutions? A better retirement begins with a written income plan. To get your complimentary written income plan, call the number that you see here. You only retire once, so this is your opportunity to plan for better.
Welcome back to Arkansas Money Talk, where today we're having an in-depth conversation on the 8 key factors you should consider before engaging in Roth conversions. And we were talking during the break, what we really hope that this show is doing is just bringing awareness to all the things that most people don't think about before they either decide to do the strategy or just blow it off and say, no, that's not for me, right? Because clearly, as we're seeing today, so much goes into this. So we invite you again to take advantage of our Roth Readiness Quiz, our free online interactive assessment, which will walk you through a lot of the things that we're talking about today. Again, you can access it by going to retirepathrothquiz.com or by scanning that QR code. But these final 2 factors we want to cover with you today, it really does highlight why Roth conversions decisions shouldn't be rushed, right? So because once those rules are triggered, you can't do a rewind button. There's no undo. And if you make a mistake, unfortunately, those mistakes could follow you throughout the rest of your retirement. So factor number 7 is how you pay the tax on a Roth conversion. Why does the source of the tax payment matter so much over the long run for someone?
Well, the main factor is most Roth conversions that are completed are taken just directly from a traditional IRA account. Because again, folks, remember, we can't go straight from a 401k. It's got to go from an ERISA plan to a traditional IRA to be able to make the conversion outside. Okay, so when the money comes from the IRA account, that's the moment it becomes taxable. Most people, or most conversions we've seen done, the tax gets withheld directly from that account, and so the residual value then shows up in the Roth IRA account, okay? So that we pay it that way. A more efficient option may possibly be, and if you've planned ahead, or we've put a written income plan in place where we have outside assets that may be sitting cash, where I can then pay the taxes out of my own cash pocket, so 100% of the amount gets converted over, may be the more efficient case in some options, but also have to make sure I keep liquidity into place, because liquidity is something we probably under-discuss on this show, but the reality is liquidity is a huge issue when it comes to retirement, because I got to be able to access money when I need it.
Yeah, for sure. That's something you definitely need to be prepared for.
Yes.
And then factor number 8 involves required minimum distributions, RMDs. So how do the RMD rules really complicate Roth conversions once they begin?
Right. Someone who's doing a Roth conversion and they're already RMD age, they have to first take their RMDs before they can actually do a conversion. So there needs to be an order of operations set up so we don't incur any penalties from not doing it correctly. So there is a process for doing this.
Well, something else to consider there too, Kristen, is, and I don't want to make sure we overlook this because I know our audience happens to be very charitable. And so if I have charitable aspirations, that's something we want to have the discussion up front, because if I ever have the opportunity to take money from a qualified charitable distribution where I take it directly from my IRA account, I send it straight to the charity, I'm never going to pay tax on that money. So it doesn't even make sense to convert it and pay 10 or 12 or 5% when I can always pay 0. And so I want to be thoughtful to those calculations, plus the big beautiful bills now giving married filing jointly couples the ability to deduct up to $2,000 a year of charitable. So it's not completely gone away along with our standard deduction. But there's a lot of thoughts in your long-term outcome that'll make it a great determination what makes the most amount of sense here. Once I become 70 and a half, that's eligible, not even the 73 or 75 when RMDs come in.
Exactly. So those QCDs can be very powerful
Yes.
strategies as well. Well, clearly, we only have a couple minutes left. We've gone through a lot of information. We've given folks a lot to think about. Any stories come to mind or anything you want to leave our viewers with as we wrap up this important conversation of considering could a Roth conversion be right for them?
I think one of the biggest considerations is as we go through these strategies and somebody comes back and says, I got to get my CPA involved. And this is not to knock CPAs. My kid's one, okay? They just think about things differently in many instances. I don't know how many times we've gone through a situation and we've showed someone, hey, here's where this makes sense. This is the level of making distributions. We get the CPA involved. And he goes, oh, you're just going to pay more taxes this year. And it's like, we already talked about that. But somehow when it comes from that thing, so here's what I will say. Let's make sure we get everybody on the same page. Let's have the same conversation in advance, because if you're working with multiple advisors, let's make sure they're on the same page and they're both working for you in the same direction as well. That would be the one major that I see. The other is please just don't discount the opportunity that Roth might offer you, your spouse, and your beneficiaries. It's not a vacuum conversation, folks. We got to look down a long runway to make sure that Roth is a great opportunity.
For sure. Make sure it fits into your overall long-term financial goals and strategies, right?
Yes.
Dale, Mark, thank you so much. And thank you for joining us today. Again, we encourage you to reach out to receive your complimentary written income plan. You can do so by calling that number on the bottom of your screen. We love you, Arkansas. Thanks for watching, and we'll see you next time here on Arkansas Money Talk.